Hi, thanks so much for joining in. We're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. We've got a great show lined up for you. On the one hand, we're talking about something that one of our viewers, one of you, pointed out on social media. And we were discussing about balanced advantage funds last week. And one of you said, why don't you look at balanced advantage funds and compare them with multi-asset funds and talk about what the commonalities are and what the differences are and what you would use each of these categories for in your investment portfolio. And in the second half of the program, we'll talk about what you should bear in mind, one, before you choose to buy an electric vehicle, and two, if you are in the market for a second-hand car, as a lot of people are, then what is the checklist that you should follow? But let's start with the first conversation. We got Sharad Tandon, who's the founder of Invest at Ease, joining us at the start. Sharad, thanks so much for taking the time. Let me start with that question. It's a pretty basic question, but I think it would benefit a lot of people. What is the difference between a balanced advantage fund and a multi-asset fund, and how would you use the two?
Okay, so both of them, as the name suggests, are a combination of two sorts of asset or more assets. So balance includes equity, debt, and to an extent arbitrage fund to maintain the taxation advantage. While multi-assets, you can have equity, debt, commodities, and also foreign equity. Now, both these product categories are slightly more riskier than the pure debt fund. Balance advantage fund is slightly a notch higher than the pure debt fund. MAF or multi-asset fund is a slightly higher than the balance advantage fund also. For people, generally, the guidance is, if you're looking to park your money in, say, fixed deposits for more than 12 to 18 months, BAF is the ideal like-to-like performance. The only sense of being cautious there is it will be slightly volatile, unlike a FD, which is a straight return. It will give you more or less in the range of 8 to 12% return, depending on timing. If you're lucky, like last 1 year, where equity was slightly stable or positively biased and interest rates were falling, your BAF will give slightly far more higher than the FD returns. While in the multi-asset funds, you need to be cautious of 2-3 things, in the sense, when as an investor, I am looking at sort of creating a bucket for myself individually in multiple schemes. Instead of that, I am taking a particular fund. So in that light, I need to be very cautious of what sort of fund I am selecting to invest. It will be slightly more risky than BAF, but better than the lot of other options we have, like pure equity, which are extremely volatile.
Get into the nitty-gritties and how to select, because as I understand it, in the balanced advantage fund, the relative commonality of strategy is more than in the multi-asset fund. The divergence of strategy is more in the multi-asset fund strategy, because the requirement is to have at least 3 asset classes in your multi-asset category, and the stipulation is to have at least 10% in each of these 3 categories. And so therefore, it's a pretty open landscape for a fund manager to choose from. So when you're talking about the balanced advantage fund, how do you select? And then we'll get into multi-asset.
Yeah. So for the advice which we typically give to all our investors on the balanced advantage fund side is, and that's an empirical guideline. So please look at your own risk profile before selecting the funds. We probably, to enumerate my point, we'll probably take some examples there also. So balanced advantage fund, I'm looking at slightly more risky than the FDs, a notch higher, but my risk profile is still low to moderate. Now, I need to be cautious of the fund manager with a longer track record, and the consistency is important rather than volatility. So our advice is generally to look at a larger fund houses like Prudential or say SBI or SDFC or say Nippon. While if you look at pure absolute return, there are new fund houses like Mahindra and White Oak also who have done purely absolute return in terms of performance. But for me individually as an investor, what will I look? If the equity profile of the equity portion of the balanced portfolio is matching my need, and typically in the BAF fund, our advisor is stick to the fund which holds the large cap funds, large cap stocks. In the debt portion, because it's slightly, I want a security, I will look at a portion of the debt which gives me slightly lower end of maturity rather than longer end of maturity in case interest rate cycles move negative to us. Because in a debt, the valuation returns are like a seesaw. If interest rates go up, your returns are high. If interest rates go down, your returns are go up, returns are low. It's inversely proportional. In that scenario, we need to be cautious of these two and how much of the portion of equity allocation is part of the arbitrage. Because arbitrage is very safe, defensive sort of bucket within the portfolio. And I'm saying safe because fund houses cannot carry a naked long or naked short depending on their view. And at the end of the month, the maturity of the expiry of the futures, the price point and the market value will come to and meet.
Yeah.
So you are only making returns on that volatility.
So therefore, with all of these parameters in mind, Sharad, and I'm not asking you to have recommendations, but based on these filters, which schemes are top of mind?
So for us, the way we look at it, in this set of BAF, if you look at as an investor, there can be two categories of the investors, which are one is bucket, which is slightly okay with the volatility, and one is a bucket which wants a very defensive. So in the defensive category, the top of the chart, which comes to the mind is something like Prudential BAF, because they've been very dynamically managing their net equity exposure. And we can look at last 7, 8, 10 years record, you will find that. Now, in the BAF, the other category is, which is slightly aggressive. So which is your something like say Axis BAF or SBI BAF, which are large fund houses, Nippon BAF. But in the equity portion, they might still go with some mid and small cap exposure and probably play on the duration of the fund on the debt side also, which can result in slightly far more volatile compared to Prudential.
Okay, understood. Now, multi-asset you've spoken about can be slightly more volatile, and so therefore somebody has to bear that in mind. And 3 to 5 years is what you've identified as the ideal time frame to hold something like this. What would you look at? Because as I've mentioned, the strategies can be pretty diverse. Something like a Whiteout Capital has traditionally had more gold. Something like an Edelweiss multi-asset fund has had more arbitrage. So how would you look at it?
So perfectly captured, Alex, on that side. So how do we look at multi-asset? Because it's a combination of different risk profile within one namesake. So let's go take some example and we'll elaborate on that. For example, a Bajaj Finserv, a new fund house, say probably with a lesser legacy, not the group, but the fund house itself, plays only with debt, gold, silver, equity. That's where it will play into. Someone like say Nippon multi-asset fund will play in the foreign equities also. While someone like say Prudential will play into silver, gold, and base commodities like copper and agri also. While someone like Edelweiss, as rightly pointed out, will be far more conservative with the arbitrage being a larger portion of allocation. There are examples in the fund houses where you will find something like people taking exposure to currency also as an asset. Now, as a retail investor, the problem we face is we might know an asset class, 2 asset class, 3 asset class, but not a combination of all. And how of these all asset class are correlated to each other, whether directly, inversely, and what is the difference in terms of convergence ratio in terms of their performance. For us, the way to look at it, each of these cycles, whether it's interest rate or a metal cycles, typically takes around 3 to 5 years of time period to play out. If you're lucky and you've got into a mid-train and probably 2 years is where you'll make money. If you're unlucky, you will start and you'll have to stay 5 years. That's where we say ideal scenario, 48, 50 months, 60 months sort of scenario to hold ideally.
Again, because of the changes in the way that these funds are taxed, they become more attractive, don't they? And fund managers do tweak things to make them more attractive post-tax as well.
So not necessarily. So the catch there is because foreign equity still is considered as a debt allocation. for tax purposes. So for example, in Nippon, their constant equity exposure is to the 50 odd plus minus 2, 3, 4 percentage point depending on market valuation. But the rest 15%, 20% goes to foreign equity. So more often than not, you'll find something like Nippon MAF, a slightly stable fund, because they will ensure the equity allocation doesn't exceed, but it will not have the tax advantage of equity taxation. While in some other funds like Prudential or say Axis or SBI, you'll have the advantage there. BAF is very clear. Most of the fund houses maintain more than 65% allocation of equity and arbitrage put together. So for all practical purposes, if you hold beyond 12 months, long-term capital gains, less than 12 months, short-term capital gains, and that's how it will be treated.
Okay.
But the best part is, and Alex, I'm just adding this point on this is,
Yeah.
if someone is looking at doing a sort of regular income, because these are the risk profiles of clients who are slightly moderate to low risk, the SWP sweetens the tax impact. It reduces the tax impact. You can do a reverse of SIP.
Yeah, that makes a lot of sense. And also the other tax aspect that you need to bear in mind is that if you are shuffling between fixed income and equity, then you don't have to do that, and you don't have to pay the tax at each point because the fund manager is doing that for you, and so there is no tax implication. Sharad, thanks so much for joining in, and this has been an insightful conversation.
My pleasure, Alex. Always pleasure to be with you. Thanks a ton.